It's Brian Preston, the money guy.
So let's transition and talk about what are the planning opportunities.
Okay.
So, well, we're in December of 2017. By my
Last few
calendar,
days of
means
December.
we have a few days to think about this. And a lot of people are probably like, wow, what can I do right now to take advantage of it? And just general macro senses of things. If you know tax rates are going to be lower next year, and deductions are going to start being minimized in the future year, it probably means a good strategy would be to let's defer income into 2018.
Right.
And let's try to get some deductions into 2017.
Sure.
That's probably a great planning strategy. But there are some things, some traps or some limitations that you need to be aware of. So the first thing is that if you live in one of these SALT, state and local income tax communities that has a rate where you're paying well over $10,000 a year, if you add up all of your taxes paid to your state and local governments and it exceeds $10,000, I'm talking about your property taxes, your state income taxes, your local community taxes, right. Maybe you have ad valorem tax on your cars. Mm-hmm. If that stuff's exceeding $10,000, you need to be like, wow, is there anything I can pay now?
Before the end of this
Before
year.
the end of the year. But here's the only limitation. Make sure that your community can actually take it. Because it's one thing for me to tell you, hey, well, you know what a great planning opportunity would be? For you to go ahead and prepay your 2018 property taxes. And you go cut a check to your government, and then the government gets a check and goes, what do I do with this? What do I do with this? So, because I don't know that governments are necessarily set up to take that money a year early. So definitely call your local community and see if they even can take that money. Now, a lot of you smart people were probably saying, well, wait a minute, I'll just go ahead and pay my state income taxes.
I'll just write a big old estimated tax
payment. Write a big old check, and it will be deductible. I'll get that money in, and, I'll laugh at the government in 2018. The government actually outsmarted us a little bit. I still want you to prepay your state income tax for 2017, but if it pertains to 2018, meaning if you overpay what is owed, and it rolls into 2018, you don't get a deduction for that in 20. They kind of outsmarted us on that. And the other thing about making a big old state income tax payment for 2017 is, remember, we still have the old alternative minimum tax rules. So there's a good chance some of those state income taxes are going to get phased out. So you need to go pull last year's taxes.
That's right.
Look and see how much alternative minimum tax you paid.
And how much you owed for your state tax due last year.
So I don't want you to go create a bunch of work only to find when you do your taxes later, you go, well, gosh, Brian told me I was going to get a deduction for prepaying my 2017 taxes. I would have much rather had that money for another 15 days. So you need to understand how alternative minimum tax and your state income taxes, but remember, only pay what you owe for 2017. It's not going to benefit you to pay those state income taxes for 2018 and 2017. They outsmarted you on that, so don't do it. You also need to look at your itemized deductions. Realize next year, the standard deduction for married people is going to be $24,000. Yep. And it's not only your itemized deductions or your standard deduction, it's also going to include your personal exemption. So when you look at your tax return and you look at your deductions, maybe your itemized deductions for last year, if they didn't exceed $24,000, you probably ought to go ahead and load it up into 2017 because there's a good chance you'll never itemize again.
That's right.
I mean, that's something. So if you have some charitable contributions you can make now at year end, go ahead and do it. This is an opportunity for you to consider going ahead and bringing that forward and getting a bigger deduction. Itemized deductions, they're gone. In 2018, these things are disappearing. So if you've got a safety deposit box,
you're talking about the miscellaneous
fees, the miscellaneous itemized deductions. Did I not say the miscellaneous?
I think you left out the miscellaneous part.
That miscellaneous is a very important word. The miscellaneous itemized deductions will be going away, so definitely take advantage of those, because that's also including your unreimbursed business expenses. Mm-hmm. Maybe you have a bunch of expenses that you put in, you pay for yourself, your company does not reimburse you for it. If you got something that you were thinking about doing in January, February, March that was going to be unreimbursed, go ahead and do it right now and bring it in. You just got a few days to take advantage of it. That's something you ought to consider.
So if I'm sitting here, Brian, and I go look at my tax return and I'm a single individual, I'm like, man, I don't have $12,000 of itemized deductions year over year. If I'm married, I don't have $24,000. what are some things that I could be thinking about moving forward as an opportunity to maybe not game the system, but be a little more tax efficient in how I, fund certain life goals?
No, this is the stuff that I get excited about because this is what we do for a living. I mean, is try to come up with strategies, come up and make sure people are thinking about ways to handle their money more efficiently and effectively so that they really get that. Remember, the goal of the Money Guy podcast, I want your money to go 3 to 5% further than everybody else. And part of that is just understanding what the planning opportunities are. And one of them is, I think you ought to consider stacking charitable giving. And that doesn't mean, because you hear that, you're like, gosh, so that means 1 year I am going to be the most generous person in the world, and the next year I'm going to be a miser. That's not exactly what I'm saying, because there are cool planning tools out there that will help you, even though you might, for tax purposes, look like you are just doing very generous in 1 year and then very limited the next, because you are stacking these things because you're trying to exceed that standard deduction that's now so much higher. What you can actually use is both Fidelity, Schwab. I mean, there's other ones out there. They have charitable gift funds where you can give appreciated, stocks, mutual funds. It doesn't matter. Or just give cash. For tax planning purposes, cash might be necessary. You can put them in these things. You'll get the deduction on the time that you make the contribution or the transfer, but then you can determine over the next year, 2 years, 3 years, how you want to spread and make that contribution. So that way, maybe your church or the organization you are interested in funding, they don't have to be in a feast or famine type situation. There's actually a planning opportunity if you stack your charitable giving to exceed that standard deduction and take advantage of it every other year or so forth.
So the real easy mathematics here is if you're a family that makes, I'm going to make up a number here, $150,000 a year, and you like to give away 10% per year, rather than giving the $15,000 every year, every other year give 30. If you have, some assets that will allow that to happen. And then you can still funnel that to the organizations that you support on a monthly or quarterly basis, however you like to do that.
Yeah, so that way your cash flow is not necessarily different, but from a tax impact stance, it would definitely be in your best interest. The other thing is you probably want to be strategic with your medical expenses. I thought it was quite interesting with this tax reform. They didn't go retroactive on hardly anything. I mean, most things are going to kick in as of January 1st of 2018, even some things getting deferred out till January of 2019. But with medical expenses, because this was something that from I guess you call it controversial standpoint, they were thinking about on the House bill, they were just going to do away with this deduction. Yeah. And that was very scary for a lot of people. Well, as y'all know, I have a special needs child. She goes to a special school, and there's a lot of parents at that special school that are actually the tuition for the private school is a medical expense because it is such a specialized school for alternative learners that it was going to break my heart if all of a sudden, because it's a hardship to spend $40,000 a year for tuition for your special needs child. I mean, it's nice that at least some of these people got to take a tax deduction. Sure. If that went away, that was going to be a true hardship. And it's not just school. I mean, all the speech therapy, all the occupational therapy, all the things. And there's people who have other, special needs. I'm sure they can list off a group of specialists and doctors they have to go see. So I was like, man, this is crazy that they're going to do away with this. So, because it was 10%. You had to have medical expenses that exceed 10% of your adjusted gross income before they were deductible. So I was glad to see when the actual final bill came out, they didn't do away with it. They actually made it better. For the next 2 years, instead of it being a 10% threshold, it's a 7.5% threshold. So, and that's retroactive to 2017. So, my thought is on this though, be strategic with those medical expenses. There might even be an opportunity because you have that threshold of 7.5% you have to exceed. Maybe if you do need to stack those if it's things that you can actually pre-plan. Now, obviously, with medical you don't always get to plan, but if you can, be smart with it. Was there anything else that you wanted to kind of talk about before we got into the macro things?
No, I think those are the big opportunities that we saw from this. Obviously, it's kind of a summary. Defer income into future years, accelerate deductions into this year, and then moving forward, think about stacking so you can really take advantage of the itemized piece.
Here's another one that I was planning on getting into the details, but I think for my people who aren't going to go nerd out with us, that they might disappear. You've heard us pick on, I think one of the biggest, hardest pills to swallow in this tax bill is if you do live in a high tax state, you're worried about having that cap of $10,000 for all of your taxes. one of the big planning opportunities comes in the fact of 529 accounts.
Yeah.
Now are going to not only be useful for college education, they've changed the provision where now K through 12 private school and education becomes a priority. So if you live in one of these high tax states, it becomes more imperative for you to consider looking at what does your state 529 plan allow in tax benefits from a state perspective. Like in Georgia. It was at $4,000 per child is tax deductible no matter what your income is. So if you think about it, that's a free 6% match, they're giving. So somebody who's paying, take advantage of that. Because now that especially if you got a kid in K through 12 private school, it might even be beneficial enough that you put the money into the 529, take the tax deduction in the current year, and then still take the distribution to pay for the private school.
Same way people use HSAs.
So make sure you're paying attention to what happened with 529s because there's going to be a greater opportunity there. And I'll get into more details on it, but I wanted to make sure when we're talking about opportunities that one didn't pass us by. So let's talk about the macro changes or reading the tea leaves because this is the part where I think that I'm hearing nobody talk about it that I felt like we could give some thought to, and hopefully you guys could internalize this and figure out how what this means for you and your wallet, maybe even where you need to live over the next 5 to 10 years. One of the things that I think the biggest part that came out of this tax policy, and we've been very much taking advantage of this for years, is that there is a human nature element that occurs. We all hate paying taxes. If you talk to anybody, I think I made the first 3 to 4 years I started my company, I got most of my business from small business owners because I have a background in taxes because the first thing that usually came out of their mouth was, man, I got to quit paying so much in taxes. How can it? So that we have a human nature, especially if you are paying a lot of taxes. How do I minimize this? So there's a little bit of, it's like music to your ears when you hear the word, it's deductible.
Yep.
I mean, there is something very powerful about hearing it's deductible. It kind of gives you like, whoa, I need to be doing that because that lets me stick it to the man legally.
Yep.
So I got to take advantage of that. And we tell this to small business owners. We tell this to retirement savers. Guys, you got to be loading up those retirement accounts because realistically, the government's paying 25 to 40% of your contribution through tax savings alone. So that's a very powerful narrative that we use in our business. Well, I think state governments have also been using this it's deductible narrative to their benefit because what happens is they've been pushing up their local taxes and, in you as a citizen, you're like, well, I hate paying taxes, but don't worry. It's deductible.
Yep.
The federal government's going to give you a huge tax deduction on this. So no big deal that, because your federal government's going to be paying 25 to 40% of those state income taxes. It's deductible. Well, we all know that now is gone. Or it's capped. It's minimized significantly because now, it's 15%. I mean, $10,000 for everything. And where this comes into play, I know when I talk to my neighbors who came from areas like Chicago, I think half my neighborhood is from Chicago, actually. Where they're telling me they're paying property taxes of $20,000 to $24,000 a year. They're paying state income tax well over $20,000 a year. And you start hearing these things, you're like, wow, this is going to have a huge impact on people who live in these states. And I think that what I worry about is what happens now when the citizens of these states now start going, well, what am I getting for this? I don't get the tax deduction anymore. What's the impact of this? And the loss of a good tax deduction is going to cause for some hard discussions, I think, in a lot of these states and a lot of these communities. And I want to talk about what is a reasonable amount of taxes to be paid. And I want this to be a healthy discussion. And I wanted to give some of my background. Because I used to go to I was a county commissioner for about 5 years and used to go to conferences and other things and meet with other local government officials. And one of the things, there was some books that I had read and some things that I had tried to share with other commissioners and elected officials I talked to is that I was worried about this new paradigm we were in and the fact that it's just like I told you, my neighbor was from Chicago. Well, what's interesting, his wife does stuff that relates to the West Coast, like in the San Francisco area with the medical field. He's working for a technology company that's also based in California. yet he's living in Tennessee. You're noticing geography doesn't mean back when, and this is what I was trying to talk to other elected officials about in the past is that in the past, you wanted to have your big company and you worried, having that big company was enough, to where a 20-mile radius around that big company, you knew you could get employees there.
Sure.
And it was important that you had the interstate, 10 miles from, so all these things, all these things went into play. You had to have your infrastructure of a good highway system. You had to have the company there for people to go work. And you need to have a good school system. These things all went into play. And that's really the the environment that we were all in. Well, now it doesn't matter where you live. I mean, now you as a community better be competitive, not only from an education standpoint, quality of life standpoint with parks and fun
Tax
things
costs.
to do, but your taxes have to be competitive because now your people have options. If they don't like the taxes, more than likely their employer will allow them go live somewhere else and still do some work for them. So I think that we definitely need to have a discussion on this. I know when I was on the school board, one of the biggest things that was important was what does it cost to educate each child and how much of that money was making it to the classroom and how much of that money was being spent on, superintendents, central office, because those things,
administration,
they're a necessity, but they're not, that's not rubber hitting the road and, teaching the student.
Right.
It was a necessity, but you wanted more money going to the classroom than you wanted in central office. Yeah. And it used to amaze me. The community I was on the school board with, our cost per pupil was around $160 for administrative costs. But yet the city of Atlanta, which you think the bigger the school system, because we had about 40,000 students, they had even more.
Right.
The bigger, economies of scale, it should be cheaper.
Should be less expensive.
But they were spending $3,000 per child on administration. That's not $3,000 per child in the classroom. They were spending $3,000 just on administration, meaning superintendents. So that's not a healthy use of facility, of resources. And I think that hopefully some of this macro stuff can have some discussions on what is reasonable and what's not reasonable, because I think geography is going to change. This stuff I think is going to have a bigger impact than people realize. And you need to look at this from your own standpoint too, because if you have the ability, it might make sense to see, am I living where I'm supposed to be living at this point?
Or and living in the place that it makes the most sense from a financial perspective. Yeah.
So I just challenge you, and maybe you didn't get anything out, but I just think that over the next 3 to 5 to 10 years, I want you to watch the macro migration I think that there really will be some impact from this because nobody's talking about that, but there is going to be some behavioral changes that occur because of the tax policy.